Hey everyone, it's Joel back with you from Geek Studios, and this is your mini charge episode for Tuesday, January 6, 2026. Today, we're diving deep into the contrasting fortunes of two major Korean automakers in the US EV market, Kia and Hyundai. December 2025 delivered a tale of two extremes. Kia's EV sales dropped more than 50%, while Hyundai's sales grew steadily, even as federal incentives expired. Why did this happen? What does this tell us about the US EV market, and what should buyers, investors, and enthusiasts like you watch for in 2026? Stick with us because we'll unpack all of that from numbers and model specs to strategy and market trends. Before we jump in, here's some context. In 2025, the US EV market hit around 1.4 million units sold, representing about 7% of total car sales, up from 6% in 2024. While EV adoption is growing, the market has shown some volatility, particularly in the final quarter, largely tied to those expiring federal incentives and intense competition. Let's dive deeper into Kia and Hyundai's numbers. All right, let's start with Kia. December 2025 was a challenging month, with US sales dropping more than 50% compared to November. Specific full year 2025 data from early 2026 shows EV9 sold about 15,000 units, and the EV6 sold around 13,000 units here in the US. That's a dramatic fall and sent ripples through dealerships and investor circles. The main culprit? The federal EV tax credit expiration. Buyers could get up to $7,500 off an EV, which created a rush in October and early November. Many buyers front-loaded purchases to take advantage of this credit, leaving December as a quiet month. But timing alone isn't the whole story. Kia also faces stiff competition from other EV makers. Tesla Model Y continues to dominate the segment, while Hyundai's Ioniq 5 and Ioniq 9 are strong alternatives. And there are other EV manufacturers nibbling at Kia's customer base. Let's break down the EV6, Kia's flagship EV, and for an odd reason that is unknown, sold less vehicles in the US than the larger, more expensive Kia EV9. The EV6 has a range of up to 310 miles on a full charge. That 800-volt ultra-fast charging network, which gets you 10 to 80% in about 18 minutes, 0 to 60 in under 6 seconds for its GT model, with a price starting around $44,000 before dealer incentives. While the EV6 is highly competitive on specs, losing the $7,500 tax credit makes a noticeable difference for consumers. Analysts say Kia may need to consider increased dealer incentives, lease promotions, or even model updates to regain momentum. Earlier this year, there were some awesome lease promotions for the EV9, which could explain its higher sales number than the EV6. Some predict that without such moves, Kia risks falling behind Hyundai and Tesla in the US market share, especially as EV competition intensifies in 2026 from other manufacturers. Now let's talk about Hyundai, Kia's corporate cousin or sister, whatever you want to call them, managed to grow US EV sales in December 2025, even after the federal tax credit expired. The Ioniq 5 has similar specs with the EV6, considering they are sisters or cousins. It gets a range of up to 303 miles, that same 800-volt fast charging architecture with a 10 to 80% in 18 minutes, a 0 to 60 in about 5.2 seconds for the all-wheel drive versions, with a price point starting at around $42,000 before incentives. Also, Hyundai's Ioniq 9 has broadened the lineup with a move into the three-row SUV family. Hyundai's strategy is diversification, multiple price points, segments, and tech features, reduce reliance on short-term incentives. Meanwhile, Kia leaned heavily on the EV6, leaving them more vulnerable to month-to-month sales swings. Another factor, brand perception and dealer support. Hyundai invested heavily in EV education for its U.S. dealer network, meaning buyers felt confident about charging infrastructure, maintenance, and resale value, something Kia still needs to strengthen. Analysts note that Hyundai's success isn't luck, it's strategy. By offering multiple compelling models, strong service support, and forward-thinking tech, Hyundai captures buyers even when incentives fade. Also worth noting, Hyundai's partnership in the U.S., including collaboration with charging networks like Electrify America, make fast charging more convenient, another edge over Kia, in a competitive market. So let's zoom out and take a look at the bigger picture. What Kia and Hyundai's contrasting performance tells us is not just about the companies themselves. It's about the dynamics the U.S. EV market is heading in 2026. First, federal and state incentives directly shape demand. The expiration of the $7,500 federal EV tax credit caused Kia's December sales cliff. That's a clear example of how sensitive the market is to policy changes. But it's not just federal incentives. Many states still offer EV rebates or tax credits. For example, California's Clean Vehicle Rebate Project offers up to $2,500 off, while New York has up to $2,000 in state rebates. This patchwork of incentives means automakers must strategize regionally, not just nationally. Experts note that this uneven policy landscape can favor companies with a diversified lineup, like Hyundai, which can sell across price tiers and states. Companies like Kia, with heavier reliance on one or two models, can feel the effects more sharply when incentives change. We also have some increasing competition. The U.S. EV market is no longer niche. It's highly competitive. Let's look at the numbers. Tesla delivered roughly 400,000 units in the U.S. in 2025, still leading the market. Ford saw a 40% increase in Lightning sales in Q3 2025, but has announced it's discontinuing the all-electric truck. In the Rivian R1T and R1S, totaled around 15,000 units sold in Q4, showing growth, but still small scale. Against this backdrop, Kia's December's drop is particularly painful. Every lost month benefits competitors. Hyundai, by contrast, has maintained momentum, securing roughly 47,000 EV sales in 2025. That's a testament to brand trust and product diversity. We also have consumer behavior and trends. Consumers are becoming more savvier about EV features. It's no longer just about price. People care about real world, not EPA estimates in range. They care about charging infrastructure, accessibility of fast chargers, home charging options, and partnerships with networks like Electrify America and Iona. And they care about performance and tech. Features like adaptive cruise, driver assist, digital displays, digital keys, and over-the-air updates matter a lot. Hyundai's Ioniq 5 and Ioniq 9 are perceived as premium but accessible, striking a balance for a broader audience. You also have market saturation and sales cycles. Another factor to consider is market saturation. In 2025, U.S. EV penetration reached about 7% of total vehicle sales. But in certain states like California and Washington, EVs represent 20 to 25% of new sales. This uneven adoption means automakers need strategic timing for release and inventory management. Kia may have suffered because most of its buyers rushed to get the EV6 before incentives expired, leaving a temporary gap. Hyundai avoided this because of multiple models and price points, keeping sales flowing. And finally, you have expert insights. Industry analysts suggest that 2026 could be a turning point, with federal incentives gone, and automakers who invest in charging infrastructure partnerships, maintain diverse EV portfolios, and focus on customer service and brand trust will likely capture more market share. Hyundai fits this profile. Kia will need to adapt quickly. Consumer surveys also show that range anxiety remains a top concern, even for buyers who know the technology is reliable. Hyundai's investment in fast charging networks give it a psychological edge, reinforcing why its sales are holding steady. Let's look at the global context. U.S. EV sales don't happen in isolation. Globally, EV sales are expected to slow slightly in 2026, especially in China and Europe, due to increased competition and the changing incentive landscapes in Europe. That global slowdown could affect pricing and availability in the U.S., making strategic planning even more critical for Kia and Hyundai. To wrap up, Kia and Hyundai provide a clear lesson in the highs and lows of the U.S. EV market. Kia's December's decline highlights the impact of incentive-driven demand, while Hyundai's growth showcases strategic foresight and diversification. As we move through 2026, watch for new model launches, pricing strategies, and incentive programs that will shape who wins the U.S. EV market. All right, that's your mini charge episode for today. If you enjoyed today's episode, don't forget to like and subscribe on YouTube. And if you're listening on Spotify or Apple Podcasts, tap that follow button and leave us a quick rating. It really helps the show grow. If you found this episode helpful, make sure to follow EV Geek Studios on social media. And don't forget to tune into our Friday Charge episodes, where we dive deeper into stories like this and break down what they mean for you, the EV driver and enthusiast. Until next time, stay charged and stay geeky.